Hey guys, hey everybody. It's Roxanne Grace here. Good afternoon, good evening, good morning, depending on where you are in the world watching this. Go ahead and comment. Let me know where you're watching from. I'd love to know. So what I'm going to do right now is I'm going to take a little bit of time and I'm going to share how I do my chart setup, how I, or at least the basics of it, just so some beginners, people who might want to know a little bit more about it, they can maybe get an idea. Okay, so here we go. I'm going to go through how I do things. First thing I do, you guys, I start with a website called Trading View. So bring over here real quick. This is tradingview.com, tradingview.com. And what I do here, I use TradingView because I can take TradingView on my mobile device anywhere in the world. I can log in real quick from a hotel computer. I can, borrow my sister's phone and look in her phone and pull it up and log in and be able to mark up my charts, change my charts, read my chart setups. And it's a little bit more thorough than just using MetaTrader 4, which a lot of people tend to use. I'm not knocking it. I use MetaTrader 4 to enter my trades, but as far as chart setup, I do it all on tradingview.com. So if you're going to be on my team, if you're going to grow with me toward financial freedom, I highly suggest you get used to using TradingView because all of my teachings, all of my examples are done on this platform. Okay, they should pay me for that because that was such a plug. But anyway, so for those of you guys who are new to Forex, let's start off here. If you're brand new to Forex and you're not sure about a lot of stuff, this might help you a little bit. But one of the things I do want to point out to you guys that one of my mentors told me when I first started trading, he said, trade one pair. Focus on one pair, stick to that one pair for a year, get to know that pair. Actually, what he said is like a chick or something, but I'm not going to go into all of that. God bless his soul. But pick one pair and stick to it for a year, something like that, and don't change from it. Get to know the way it moves. Get to know the ins and outs. Get to know, what news makes it go up, what news makes it go down. Get affiliated with it. Get to know that, okay? Those of you guys who've been out here trading for a while, that's cool. That's cool. This is a beginner setup. This is a very basic setup, all right? I'm not going to dive into channels. I'm not going to dive into peaks and valleys. I'm not going to do all of that. I'm going to do basic chart setup. If you've been in here for a while, you can work with more pairs. You're probably more used to dipping and dabbing around, going in and out of trades than some other people. But so what I'm going to do right now is I'm going to just go over the United States dollar versus the Japanese yen. And that's this pair that I have up here on this screen, the USD Japanese yen. So I'm going to go ahead and talk more about that, get further into that. For starters, the first thing I do before I get into any trade, I check the currency index. Okay? So what this allows for me to know is which pair is stronger. Okay? Which one is stronger, not which pair, which currency is stronger. So I come right over here to my search box here, and the United States dollar is called DXY. So I typed in DXY in search, and United States Dollar Currency Index came up. I'm going to click on that. I want to know what the USD, how strong it is right now. So I'm going to let that load. Oh, goodness. So the United States dollar is showing that it is actually weak. That's why it's in red. It is negative. It is weak. So it is a negative 16%. So the USD, the DXY is showing it is weak. Now I'm going to go over, I'm going to jot that number down because it's an important number. I'm going to come back up here and I'm going to go check on that the JXY. So JXY, that's the Japanese yen currency index. Okay, and the Japanese yen is actually strong right now at a positive 15%. So that's cool. I'm going to jot these numbers down and I'm going to take them back on over here to my chart. Okay, so let me get some text out because I want to write on here. Text. Here we go. So right here, I want to put this is the dominant pair in this is the USD. So whenever you're, let me do this real quick. Whenever you're looking at a pair, right? We're looking at USD JPY. This first pair right here, that US dollar, the one that comes first in it, is the dominant pair, okay? So I want to go ahead and get my indexes down here. So I have my DXY, which was negative 16%. So it is weak. Then I have my JXY, which was a positive, 15%. So I know that the JXY is strong. Okay. Alrighty. And what I also like to do, guys, not only do I like to put that information, oh, that's a little big. Let me click back in that. Not only do I like to put my information on my directly on my charts, you got directly onto my charts. Let's see here. Let me get that right. It's gonna bother me. Here we go. That works. Click OK. Okay, now we're cooking with fish grease. Sit that over there. So now I know I'm in the United States dollar versus the Japanese yen. I know that right now the United States dollar is weak, and I know that the Japanese yen is strong. Now, if you notice, nothing's moving on this chart. Nothing is moving because it is the weekend and the Forex market is closed. That is when you want to do all your chart setups, because that is when it's easier. You're not worrying about marking your highs and your lows and then something move on you. So going forward, the United States dollar being the dominant pair, when you look over here, what this is showing you on the right-hand side here, you see the 112.36. That is the conversion rate. So right now, if you were to take a plane to Japan, get off an airplane at this very moment and try to exchange your money, okay, you are going to deal with the price level conversion rate. So what this means is $1 equals 112 Japanese yen. Okay? $1 equals 112 Japanese yen. All right? So this is what we're trading every day, you guys. That's why it's called the foreign exchange market. This is the exchange. We're talking about the exchange rates, okay? So right now, the United States dollar would be 112 Japanese yen if you go over there and exchange your money. Now, if you converted it back to, if you were coming back to the United States and you might have purchased it at 112, but when you go to trade it back, it might be differently, or the United States dollar might be higher. And what ends up happening is you can profit or you can actually lose based on the fluctuation in the conversion rate, okay? Now, like I told you, the USD is dominant, so everything we do in this particular pair with the USD first means that everything is going to be based off the United States dollar. So if the USD is weak and the JPY is strong, then the market is going to be going down. If it's vice versa, if it's flipped around, if the JPY is strong, if the USD is strong and the JPY is weak, then the market will be going up. What I like to do, you see over here on the right-hand side, I added some symbols over here. I didn't add other symbols that I trade. I added the currency index, because that's really what determines a lot of time how I trade, is what's going on, where the strength of that particular currency is at. So you see where it says Roxy's faves, I have my favorite currencies sitting over here. Those are usually most of the majors that I keep up, so I know what's going on. Let's see here. Now, what I want to go over here, if you look, we're on the day chart. Let me go ahead and make this a little bit bigger. And on the day chart, each and every single one of these candles, these are called candlesticks. These green ones are going up. That means they're in a buy. That means they are bullish. And these red ones are sell. That means it's in a sell, that it is bearish, okay? So when you hear me refer to the market's bullish, that means the market is going up. You hear me say bearish, it means the market is going down, guys, all right? But this is, if you look at right up here, the top left-hand corner, you see where I have the D in blue. D stands for day chart. That is the time frame that I'm on. So one of these candles equals, one candle equals 24 hours. Okay, so now if I come over here, so over a 24-hour period, so this is how many days actually, 1, 2, 3, 4, 5, 6. So for the last 6 days, this market, the USD JPY, has been going up. And for those of you guys who watch the news and things, you'll understand why a little bit more, why the market's moving up. But so the market's been moving up for the last couple days. All right. Now, if I were to go over to the 1-hour chart, go ahead and make this a little bit bigger. Please bear with any noise that you guys hear in the background. Understand, you guys, I am a mom. I'm a single mom, and all I do is trade Forex. So my kids, they know I'm always on this computer making our money to live and whatnot. So they're always in the background making noise. But that's just my life. Let's see here. So now I'm at the on the 1-hour chart. So each one of these represents 60 minutes. So if I were to take the time right now to count back 24 and put a line, that would be what one candle on the day chart means. All right. So that's just a little breakdown of that. Some basics, you guys. I told you I'm going to go over some basics. Then we're going to go into a full chart setup in just a second. But I want to go over some things that a lot of people I notice they just don't know. So I'm going to share this with you. If you have questions, comments, want to get in touch with me, please do so in the comment section, or you can inbox me. So the higher time frames, guys, like the day chart, what that does is it mocks the lower time frames. That's what I was just showing you with the example, showing you how one day chart candle represents 24 candles on that 1-hour chart. So now let's talk about the stuff a lot of people want to get into. Let's talk about what's actually moving the markets, right? What's moving the markets? What generally makes the market moves, you guys? What makes the market move is the expectations of other traders, okay? So the expectations of other traders, okay? Because of the different expectations, the market is constantly changing. It's constantly fluctuating. So this is going to lead me right into fluctuation of price, okay? Fluctuation of price is just that constant change in the market as individual expectations change. Okay. Now, I know a lot of you have been in Forex, got into Forex, and already have been digging deep. And what you're running into when you're looking this stuff up, a lot of the information you find says that it's supply and demand. Not exactly. Supply and demand are zones, and that equates to there being an equilibrium within the market. However, there's actually no equilibrium in the markets for the simple fact that there's no perfect competition. Okay, there's no perfect competition. There's no actual buy and no actual sell. Now, what I mean by that is you cannot take $1 and get $1. You cannot take $1 to buy $1. Okay, somebody's gonna look at you like, huh? Why are you trying to sell me $1 for $1? Like, huh? That makes no sense. So if that were the case and there was a perfect competition, instead of moving sideways, like you see the market going up and down and up and down, instead of moving sideways, it would literally just be a straight line, a vertical line going up and down. Okay, it'd be a straight up and down line. The top would be buy, the bottom would be sell, and there's no fun in that, right? So now that you understand that the market moves sideways in the up and down manner, what I want to go ahead and get into now is how it's constantly changing price because of the expectation of the traders, right? So what that means is that you can understand the fluctuation of price is what's moving the market. Now that you understand that, you can understand market structure. Okay, my kids are making noise. Sorry, I lost train of thought a little bit there, right? So what you understand is there's market structure, right? Now, market structure, there can only happen in 3 patterns. So I'm going to go into just a little bit of market structure. Take a look at this right now and see if you have any clue what the market structure 3 patterns are. If you know what those 3 patterns are, drop it in chat. Let me know. Let me see who's been paying attention, who knows about trading. Let's see here. So there's 3 patterns in market structure. You have the V, you have the W, and you have the M. Okay? Now, there's no Q, there's no R, there's no S, there's no X, Y, Z. You guys, it is only a W, an M, and a V. Now, the W, which is also known as the double bottom, which you see right here, the double bottom, that's the bearish reversal when when neckline breaks out. And there you have it. And then you have the M, which is a bearish reversal when the neckline breaks out. There goes your trade right there. Then you have the V, which is the fluctuation of price. Okay. Now, remember, like I told you a minute ago, when it's bullish, it's going up. When it's bearish, it's going down. So the M means a bearish reversal, W means a bullish reversal, and V is just the fluctuation of price. Now, when you come over here and you look at this market, now you might actually start recognizing that there are W's and M's. Okay, let's see here. There's W's, there's M's, right? So let's see here. There's one point on it. That's an M right here. Go. That's an M right here, guys. I'm just going to show you the M. Okay. So I don't know if you guys can see that. It's a little, but that is definitely an M right there, okay? Now, what you want to pay attention to, oh, real quick, before I go any further, right? So we have the V, the W, and the M's, right? We just went over that. We use what's called Heikin-Ashi candles, okay? This is the Heikin-Ashi candle. When you open up your chart and you start your chart, it's going to start off with these candles, which is your basic regular candlesticks. It's also what you see on your MetaTrader 4, okay? And if you notice here, for example, is where I drew my M, it looks like a lot more was going on there. This, by going over to the Heikin-Ashi candlesticks, it cleans up the trend. So clearly, it's a lot cleaner. So it's a lot less jumping in and out because of misconception of the way of which the market is going. So I definitely highly recommend using Heikin-Ashi candles, and that's how I teach trading. So I definitely want you guys to have those up on your charts as well. So let's see what's next here. So you know about the Heikin-Ashi candles. You know that there's the fluctuation of price that comes. The double bottom is the bullish reversal. The double top is the bearish reversal. And then you have the V for the fluctuation of price. Never any other patterns out there. Okay? Now, you never want to predict. This is another thing that there's a lot of, I guess, debate about. But I'm telling you guys, this is my opinion when it comes to trading. This is what I've learned from my mentor, how I was taught how to trade. Okay? So you never want to predict the market, okay? I'm not Houdini. I can't predict the market. I don't know what's going on. So I don't use pending orders. I don't use the buy stop, sell stop, buy limit, sell limit. I don't use all that. I don't put an order in and then hope that it hits my order. What I do is I use call levels. So what I'm recommending to you guys is downloading on your phone, on however it is that you do your trading, download Call Levels app. And the reason for this is what this does is as your price is approaching for whatever your entry mark is, you're going to get a ding on your phone, you're going to get a ding on your computer, whatever it is, how you set it up. And what's going to happen is now you can react. We only react to a trade. I can't tell you what the market's going to do when it opens up on Sunday, but I can do some technical analysis, and if that starts happening, then I'm going to react to my trade. If I get the buzz off that's from call levels, I could be walking through Walmart. Now I know, let me put my trade in because it's approaching my price level that I want to get into. So that's something you want to keep in mind also. You always want to react and never predict. All right? Call levels are pretty much what works, so I'm just definitely telling you guys, get Call Levels app on your phone, and that way you are reacting. So now I want to talk about trend lines. Let's go a little bit into trend lines. You have your minor support and your resistance, then you have your major support and resistance. You guys, I do major trend lines. That's what I teach you on how to identify and find them in the market, so that way you can set up your trades. Now, we set up our charts, like I might have said earlier, we set them up on Friday, Saturday, because the market is not moving, so you don't have to keep changing your immediate highs and your immediate lows. And I'm about to show you exactly what I'm talking about when I get into the trade setup here in just a second. But there's just a few more things I want to run through just so people have the basics and some knowledge as we proceed forward. You have a pip, okay? A pip, you guys, right here, a pip is the percentage in price, percentage in point. All right. It makes it an even playing field along when you bring the lot size into play. So let's say I, Roxanne Grace, let's say I have an account with $1,000 in it, $100,000 in it, and you, John, you have an account with $1 million. We can get in on the exact same trade at the exact same time and get out at the exact same time. However, if I go in on, let's say John went in on a standard, a full standard. He's going in at a $10 lot size, a standard lot, and I'm only going in at 10 cents. Even though we had the exact same trade, we're going to have different results profit-wise, okay? So like I said, I might only use a 0.01 lot, but then Johnny gets into the same trade and uses something like a one lot size, a full standard, and we catch 100 pips, right? So he might make 1,000 to my 100. He might make $1,000 to my 100, or he might make $1,000 to my $10. However it may go based off of lot size. So it completely depends on the lot size that you're trading. And this is important that you learn your lot sizes. If you need help with that, I got your back. Let me know. I have lots of charts and explanations on lot sizes, so you're not blowing your account, so that you're trading accurately. So these are how lots are, how it's calculated. You have a micro, which is only 10 cents. That's a 0.01. That's where a lot of people start their trades off at. Then you have a mini, which is $1, which is a 0.10. You have a standard lot size, which is 1.0. And this is where a lot of people make mistakes and blow accounts. You guys, a standard lot means that for every single pip, every single percentage point, you are going at $10. So keep that in mind, okay? So now that these pips are being calculated, making it an even playing field, no matter where you are in the world, the lot sizes make it fair. Along with pips and percentage price, you guys, that is what makes this a fair trading market. I can't stress that enough. So I told you about markets and how they're moving based off of fluctuation of price, and there's no equilibrium in the market. So what you should be thinking at this point is, well, how do I get into a trade? How do I know when to get in? How do I know when to get into a trade? And that's what I'm about to start breaking down a little bit for you right now. So I use this tool, and it's called the Fibonacci. All right, so I'm going to explain how I use the fibs in just a second. But where I get in on my trades is the 38.2. I call that smart money. Smart money gets in at the 38.2, and I'm going to explain exactly how this works for you. So, for example, let me go ahead and bring out the fibs. I'm going to come over here to the left-hand side. You see my mouse moving? I'm over here on the left. I'm going to grab my Fibonacci retracement, my fib retracement tool. Now, if the market is going down, you want to draw from your high to your low. Okay, guys? From your high to your low, right? Now, if your market is going up, you want to draw from low to your high, okay? Or low to high. There's a high right there, okay? And then we get in at that 38.2 mark. But what I want to do is explain why and what a little bit more about the Fibonacci. A lot of people don't understand it, and they just get told to get in at certain areas, and they don't know what they're doing. So let old Roxy break it down for you real quick. All right, let's see here. All right, guys. So here is the market. Here's the Fibonacci, right? So now each zone, and when I say zone, I'm talking about these areas here. So you have the 1, the 0.786, the 0.681, the 0.5, 38.2. So all that is right here for you, okay? Let me do this like that. Hold on. There we go. It was upside down. All right. So right here, that's the 38.2. That is where I get into my trades. But each one of these levels, they equal, they're called zones, all right? So I get in at the 38.2 zone, which is like a confirmation zone. It's smart money. That's where smart money enters the trade. And I'm going to explain a little bit more about that, because then you have the 0.23 right here. This right here is where banks enter the trade. Now, they're the ones that actually set the price on how the market's moving, but this right here at the 0.2, that's where banks start getting into the trade. And like I said, I wait for that confirmation area right here, the 38.2, which is a confirmation zone and considered smart money. Then you have the 0.5 and the 0.618. That's for retail traders. That's where retail traders get in. So let's say you're using like the harmonic scanner, which is an amazing tool, or if you're using Ichimoku clouds or the Bollinger Bands, those are going to put you in trades at the retail trading price. So we're getting in way before, based on that 0.382 being a confirmation zone, okay? Now, price fluctuation becomes stable at that 38.2 zone. So let me get a little something to draw with here. So like I was telling you, so banks are coming in right here, right? The market's moving, moving, moving. And then we're going to come in at the 38.2. Right here. But what we're looking for before we get into this trade right here, we're looking for the market actually to go above it, come back down, retest it, okay? So we're looking for the market to go above it. Let me stretch this out some. We're gonna wait for it to go up a little bit, right there. And then we're gonna wait for the market to come right back down. It's called retesting that area. And then wait for the market to shoot up. All right. And that's how I get into my trades. So what you're looking for right now is you want to have 3 consecutive candlesticks, meaning 3 candlesticks the same color above your 38.2. So let's say right here, let me do this, move that down. Let's say 1, 2, 3. All right. So let's say right here was my entry zone. Okay. Let's say this dotted line was my entry zone. I want to see 3 consecutive candlesticks, one wick higher than the next, above my entry zone. Okay. But I also want to see that after, have it retest, come back down, and then I'm going to get in it when it spikes up. All right. Go ahead and delete this stuff off of here. So when you see the market move 3 candles above this 38.2 zone, when you see it come 3 candlesticks above right here, right above that 38.2 zone on your fibs, this is called creating volume, which in fact actually creates something called a natural phenomena. When you have that volume building at that 0.0382 zone, you've created volume, creating a natural phenomenon. Okay, this natural movement of the market, it's just the natural movement of the market. It's just showing you the way the market goes, and it creates certainty. And it's that same certainty that has the indicators and things chiming in and starting to work. For the other trades, they see now that the market is going in that actual trend direction, and they follow along with that trend. Okay? As long as it's passing these zones the way it's supposed to, that's how everyone knows which way the market's going, which way the trend is going. But we're going to get in early right here at the first confirmation. We're going to get in at the 38.2, let it come down, retest, and it's going to spike back up, all right? You always want to wait for that retest. And now, if you see, if you want to make sure it's going in the right direction, but if you see, let's say for some reason the market is not, it retests and it starts going this way, don't be silly. Don't sit there and wait in the trade. Who wants to sit there and try to catch a falling knife? right? You don't want to try to catch a falling knife. You want to be smart. You want to think about this. So I'm going to follow the trend, follow the direction. I'm going to make sure that I follow the market and not get killed, right? You don't want to get killed into the trade. You don't want to, like I said, try to catch a falling knife. If it's not going the right direction, don't try to get it. Now, what we wait on is called the human phenomena. This retesting that I was talking about right here, where the market goes up, it comes down and it retests your 38.2 zone in that area right there. That is your human phenomena. That's called the retest, okay? That is the human phenomena. So that was the natural phenomena, the volume building, then it retests because of human phenomena, and then it goes up, or bullish is the way I'd like to say it. So if you get 3 consecutive candlesticks above that 38.2 zone, your outlook is going to be bullish. If you get 3 consecutive candlesticks below it, that means it's going to be bearish, meaning the market is going to be going down in a sell. All right, so this is just a little bit of teaching before I get the trade set. The chart setup is so quick and easy, but I just wanted to go over that with you guys. So remember, you have the beginning. Okay, the beginning is the 0.236. You have the confirmation, the smart money, where smart money gets in, which is the 0.382. Continuation, the 0.5 and the 0.618. That is where most retail traders get in. And then you want to cover all your trades with like a stop loss, or I use a lot of trailing stops is how I keep my profit. Trailing stops. So each level means something different. And then right here, when you get to that 100 mark, you're at the end of the trend, okay? So that's things to keep in mind. Let me go ahead and take this. Go back over here. All right. So now that you understand a little bit more about how that works, how I get the 3 candles above, you want to cut your losses, you guys. You don't, like I said, you don't want to sit there and stay in a trade. Okay, you don't want to stay in a trade. If for some reason you get into a trade and you think it's about to retest, but instead of retesting, it just starts plummeting, going the other way, cut your losses. Let winners run, and don't, like I said, don't try to catch a falling knife. Go ahead and close that out. That means if you're losing money, don't just try to hold on. Don't marry the trade, you guys. No need till death do us part. You don't want to go there. Go ahead. It's nothing wrong with getting out of a trade if it's not going the direction you need it to go. What we actually call those people that put in trades, we call them, and just hope, we call them press and play, or press and pray. These guys will press in a trade, meaning they'll key in their trade, and they'll hope and pray for dear life that it goes their way instead of using true trends and technical analysis. You never want to do that. You don't. You always want to use your trailing stop so that you don't find yourself risking too much. You want to use your stop loss so you're not risking too much. And if it's a winner, let it run. Let it make that money for you, right? Now, you also want to consider money management. Money management is huge, you guys. Money management is a big deal. You only want to risk 10 to gain 40. So you only want to risk 10% of your entire account to make 40%. So money management and risk management are 2 things that keep us from gambling. All right. A lot of people say, "Oh, you're trading Forex, you're gambling." No, I'm actually taking calculated risk in doing technical analysis and things like that. It's not gambling. Gambling is totally different. So let's say you have $120 in your account, right? If you have $120 in your account, you only want to risk 10 pips. You only want to risk 10% of your entire account. You don't, so that's only $12. Now, if you have $120 and you're only risking up to $12, that means you have 10 different opportunities. Is spelled wrong. I know, it's a quick typo. You only have 10 opportunities, okay, to get into this trade and test it to see that it's going your right way. So you want to risk 10% of your account. So that's only $12, all right? You want to gain at least $36. So your take profit should be at $36. Your stop loss would be $12, right? And that's sound, positive, good money management. You're not just blowing all your account on one trading situation. Now, you also do not want to put all your eggs in one basket. So you want to take those 10 opportunities and start off with a low lot size. For example, if you start off at a point one, now you have 10 opportunities to take that trade. But if you start off at a point five, you only have 2 opportunities to get in that trade. All right. So if you're at a 0.01, once you make $3.60 gain, you can re-enter based off your trade setup, but you're not taking a chance of blowing your account out. If you go in at a 0.05, which is the max lot size for this $120, you would be risking on 2 opportunities $6 the first time and $6 the second time. And that's all of your trade money for the day, right? Now, if I risk my money like that and then I put all of my eggs into that basket, I did not test the market. I'm going to risk $12, okay? That quickly, and I'm going to be out. You might not have enough opportunity to get to the point where you're earning your profit, making your $36. So now your risk to reward ratio, you want to remember this, you guys. You want to risk 1 and make 3 every single trade. Don't try, if you're doing 3 for 3, you're 1 for 1, you guys, that's stupid. You're risking too much. Excuse me. If you risk 1 to 1, you might as well go to the casino and play roulette. Okay? You want to risk 1 to 3. You want to, for every 1 you risk, you want to make 3. So like I was saying, $12 to make, you risk $12 to make $36. So that's your reward, $36. So, sorry. I gotta take a sip of my coffee. Okay. All better. So if you risk 1 to make 1, then like I said, you might as well go to the casino, play you some roulette, because that's gambling. 1 to 1, that's gambling. That's crazy, right? But trading is not gambling. You don't want to find yourself in that situation. Okay, when you're gambling, you're not in control of the situation. But like I always tell people, you can go to the casino, you can bet red or black, but then again, you still may lose because a 00 or a 0 come up, then you're out of there. Then what? So that's why you want to make sure that you have the proper risk management set up. So we risk 1 to make 3. I can't stress that enough. So in trading, your risk becomes your, let's see, here's on. So in trading, your risk becomes your stop loss, preventing you from losing more than you want to lose, and your reward is your take profit. Okay, so your risk is your stop loss, your reward is your take profit. You're risking 1 to make 3. So those are just some key concepts to remember. So I'm going to go ahead now. I'm going to hop on over to my chart, and I'm going to run through this chart setup real quick. I know you guys have been waiting on this. And questions or comments, drop them in the chat. Remember, you want to wait for the market to go up your 38.2 zone, come down, retest, and then you got yourself a nice clean trade, take profit up here, okay? All right, let me go ahead and delete all this stuff off here. Okie dokie. We're doing pretty good, guys. My kids normally really like straight bum rush everything I do. So whatever movie they are out there watching, praise them, hallelujah. It's allowing me to teach you guys. Sometimes, you know, certain things happen for a reason. I'm here showing you guys today. So, all right. So remember a little bit ago, before I started going on and telling you guys about some other things, we talked about the currency index. Remember, I took you over, we looked at the currency index and we jotted those down right here. So with the USD JPY, the index was, the DXY, the USD was weak, and the JXY was strong. Like I told you, I keep my indexes over here so I can keep track of them at all times. So anytime the index is above or below 10%, it's a true trend. Okay, so remember that above 10% is a true trend, below 10% is a true trend, a full 10%. Okay, now if both currencies are weak, like let's say for example over here, the BXY is at 23 and the EXY, which is the euro, so that's euro and Great British pound, if they're pretty much at the same, right? One's at 23, my arrow keeps bringing pop-ups. One's at 23, one's at 20. You guys, that market right there is probably in consolidation. If you were trading a pair, um, that particular pair, let me try to find you some consolidation. You see how the market's literally just moving sideways right here? The indexes were probably in the general vicinity of the same area. There was no major fluctuation in price. They stayed in that general area because the indexes were probably really, really close, okay? All right, so starting right now, I'm going to show you the setup and or the bias that I'll do based on the 38.2 zone. So I'm going to go ahead and get started now with my daily chart. Now I'm not going to label everything just for time purposes, but I am going to run through here and show you guys the basic chart setup. Remember that once you're on my team, we go through it in a lot more detail. We break it down for you. We teach you how to draw channels, how to do peaks, valleys channels. We teach you accumulation zones. We teach you all the market structures. We teach you NFP. We get all the way into it, guys. But first, it's very important that you know just this basic chart setup. So, I mean, my 8-year-old daughter can almost do this chart setup, but I'm about to run through it for you guys. Let's see here. That'd be a good video. Maybe one day I'll come make her do her chart setup live. All right, so here we go. So what you're looking for is you're looking for the immediate high and the immediate low. Let me get this off. And you're looking for where there was some price you're looking where there was some noticeable change in the market. So we're on that day chart. Remember, each one of these represent 24 hours. So now I'm going to come over here. I'm going to get me a horizontal line. And I go straight through across in these colors. So my day chart will be in burgundy. My 4-hour chart I'll do in red. My 1-hour chart gets done in orange. My 15-minute chart gets done in yellow. So you'll see that as I go along, but this is how I do it. I'm going to take a straight line and I'm going to find my daily high, which is right here where the market had closed out, and then my daily low, which I'm going to take this because it looks like it was low for 2 days there, so I'm going to make that a little bit bigger so I can get in there and get at the bottom of that candlestick. You always want to mark the bottom of the candlestick. You're not marking the wicks, okay, guys? Remember that? So what I've done right there is right here, I've trapped myself a piece of the market, and that is what I'm going to work with. A lot of people get hung up on what happened last year on this date. Yes, it's good to have an idea of what happened in the past so you can take knowledge from it. But real talk, all you really need to know is what's going on in the immediate. You want to see the immediate market area so you can set up your trade. Some people tend to go like really far back, but if you look back, dude, this candle way down here, that's March. I don't care what happened in March. I'm in July. So let's try to keep it in July. So my immediate market area, there was some fluctuation in price right there, changing the trend. Okay? So now I'm going to go down to my 4-hour and I'm going to do the exact same thing. Let me open this up. Okay, so what I'm going to do again, I'm going to find my line, and like I told you, 4-hour I do in red. I'm going to find my high, mark that there, and I'm going to find my low, and it's right here. And if you guys, I hope you're understanding why I'm doing this. I'm doing this because this is where the market noticeable change of price happened. A noticeable change happened right here. See, it was going down and then it started going up. So that's what I'm going to mark that there. Okay, let's see. Then I'm going to go over to my 1-hour chart and I'm going to do the same thing. I am going to mark it up. Make that bigger there so I could see what I'm doing. There we go. So on this one here, my high and my low. Take this. And again, like I said, my hour chart, I do an orange. So I'm going to mark my high. Bam. And I'm going to mark my most recent low, which is right here. Okay. So that's my 1-hour chart, guys. And I'm going to scoot over here to my 15-minute chart. And I'm going to do the exact same thing here. All right. Okay, so now I'm going to open this up so I could see it. You guys, I'll see my pictures. I've posted enough pictures of myself. I wear glasses. Even on this big old monitor, I still want to make the candles big enough where I could see them. So now I'm going to go over here and mark up my 15-minute chart using a yellow marker. Horizontal line, there's my high. Let me come over here. Let me find my low is down here. Okay, now I do the same thing on all 4 chart levels, and what that does is it creates a trading range. I'm trapping the market between this area, and I'm creating a range, a high and low range, utilizing my support and my resistance, my ceiling, my floor, however you want to call it. I know as you go through some trainings, ceiling would be like this. I'm on the 15-minute chart, so yellow, that would be my ceiling. This would be my floor. Okay, guys? Now, let's see here. Remember, we're using these Heikeneishi candles. We do not use regular candles. So now what I want to do is, now that I've identified the support and the resistance areas on all the major support and resistance areas in the market, now my final step would be to identify all my 38.2 zones, right? Using my fib tool that I was just talking about. And I mark those all out with a dotted line so I can find my entry for my trade. Now, the daily chart is your direction. On that daily chart, you identify your high and your low. Okay, your 4-hour chart, that is your momentum. Okay, that's telling you the way the trend is going. And I do not draw fibs on my 4-hour chart because that's just momentum. Then I have my 1-hour chart where I put my take profit and my stop loss, but I get my entry from my 15-minute chart. So now I'm going to go through real quick and show you with the actual fibs how I do it. Let me go back to my day chart. Make this smaller. Okay. All right, let's see here. I'm on the day chart. Let me bring this in some. Okay, so these are my day lines, my burgundies, right? So in this particular case, I want to go from my low to my high. You want to go, they're called base to base. So I'm going to come right here. I'm going to grab my fib, and I'm going to see where my low is. So I'm going to go from baseline to baseline, right? And like I said, we know because this is my daily chart that my baselines are in the burgundy, that darkish red color. And here is my 38.2 zone. So now I'm going to again use a horizontal line, but this time I'm going to dash it out. You see how I picked little dashes up there? And go back to burgundy. And this is a possible entry zone, okay? A 38.2. Bam. All right. So now I have that on there. I'm going to remove my fib so it's just not sitting on my chart. And there's my daily entry zone if I want to do a longer day trade. But that's another story and another training. All right. Then, like I said, I go over to my 4-hour chart. That's just my momentum. There is no need on the 4-hour chart to have fibs. So now let's go to the 1-hour chart, which is where I'm going to find my take profit and my stop loss. Go ahead and make this bigger. There we go. And in this particular case, I'd probably say the market, let's see here. I'm going to draw my fib from swing high to swing low. Or actually, was that market going up more? Let me see something. Uh-oh, here comes kiddo. Okay, I'm going to come watch TV with you in just a second, Pumpkin. I'm almost done, okay? There we go. There we go. I'm gonna do it that way. So now I went from my my low line to high right here. So I'm gonna go ahead and get my 38.2 in here. Orange. 38.2. There we go. And if you notice that 38.2 zone sits right there at it's sitting right there at another support level, you guys. It's not far off from another support level. They're almost on top of each other. And that's because these are major zones, okay? So now I have that there for my 1 hour. Now I'm gonna come over here to my 15-minute chart. And from my 15-minute chart, I'm gonna do the exact same thing. And from here, I'm gonna go from my high to my low with my fibs, from high to low, base to base, right? Yellow base to base. And then I'm gonna come over here and I'm gonna put my yellow dotted line at my 38.2 zone. Bam, okay? So we have that, and I'm gonna delete the fib so I don't have a big old yellow splotch. Okay, so now I have my 38.2 zone set up, right? And remember, I was just showing you on the notes here, your daily is for direction, your 4 hours momentum, 1 hour is your take profit stop loss. Your 15-minute is your entry, right? So I'm gonna take that entry line, but I'm gonna use it on the 1 hour chart. So now I'm gonna go over to my 1 hour chart right here, and I'm gonna set up my trade. So, close this. There's that entry spot, right? So what I'm gonna do here is I'm going to click right here, and I'm going to set up for a long, okay? So I'm gonna go right here. Whoa, shucky ducky. And you wanna change your risk to reward to be 3, right up in here, you're looking for your 3 to 1, right? You don't wanna find yourself stuck in some crazy long trade. Oh, there you go. That's close enough for right now, you guys. You get the picture. Hold on, Naomi. 1 second, babe. You want to say hi to my friends? Come tell my friends hi. Tell them hi. My name is Naomi.
Yeah. My name is Naomi.
Hi, Naomi. Go sit down, Naomi. Mommy's almost done, Naomi. All right. So what we're looking at right now is your basic trade setup. Okay. All right, so what you're looking at here, like I said, you want to have your 3 to 1 risk to reward ratio. So this is your entry point. Your entry point would be at the 112,600, and then your stop loss is down here at the 112,485, okay? So that's how that works. And then your take profit would be up here for the 37 pips at the 112. Okay? So that's the basic trade setup. And that is how I do it. And then what I'm looking for before I actually take that trade is I'm looking for my market to do this right here. Let's see. So what you're looking for, and what I'm looking for is for this market, whatever it's doing when it opens up Sunday, the market's probably going to continue down some a little bit, whatever. But I want to watch the market come up, hit my entry, right? So that's my entry. I want it to surpass my entry a little bit. Then I want it to come back, retest my mark, right? We want it to retest, and then I want to see those 3 consecutive candlesticks, or after I see those 3 consecutive candlesticks, I want to see it come back, retest my entry, and then, you guys, we are in it for the long haul. We're in it for the next 37 pips to take profit. You get it? So that is how I set up my trades, you guys. I am Roxanne Grace. I am doing pretty good with trading. I'm still learning every day. I'm a student. I'm always a student. And that is something that you want to remember as you are learning to trade in the foreign exchange market. You are always a student. You guys, things change daily. I learn different things. And I just want you to know that this, what I just showed you, my 8-year-old daughter can do. Okay, she can do it on her tablet. I'm teaching her and empowering her with the same skill set to move forward in life. All right. So that's how you set up your trade, and you just watch it. You want to react. There's a couple different ways you can go about it. If you want to use just the call levels that are on here, you can do that. But unless you have a paid account, TradingView will only let you set up 2. That's why I like using call levels app on my phone, and I react to a trade. So I might be sitting at a movie theater Sunday night, Monday morning, whenever this happens, and I can get in my trade because my call levels app is gonna let me know. Okay, guys? So this is how we set up our trades on Friday or Saturday. You want to do it before the market opens back up and starts moving on you guys. But again, my name is Roxanne Grace, and I really hope I get the opportunity to work further with you. I teach my team, I teach you guys, and we keep growing together into financial freedom. But that's basic chart setup from Roxanne Grace, you guys. That being said, I think I've covered absolutely everything that were in the notes here to cover, but I'm sure there's always more. Uh, but with that being said, my 3-year-old is calling. God bless, good night, and happy trading. If you want more information about joining my team, please, please, please definitely reach out to me, or you can also go to roxannegrace.com at any time to get more information. All right, guys, God bless and good night. Thanks.